Hi, everyone. This is Mish, Chief Strategist at marketgauge.com. And I want to talk to you a little bit about the macro here in the market. Although we had record inflows last week coming in, buyers, FOMO, if you will, trying to really goose this market up, what we're starting to see is some pockets that need to be watched. And so I brought with you to you today a couple of charts that I think you might find interesting. But let's talk first about the yields because, of course, we have the big Fed meeting coming up this week. And there is an overall acceptance, it seems, in the market that the Fed will not be nearly as dovish as people thought. And we may see about 2 or 3 cuts, maybe about 0.75% lower in interest rates at the end of this year. And that's it. Remember, we started out this year looking at like 5 to 6. So the question is the market really reconciled with that? And that's why we look at a couple of things. Number one is we look at the junk bonds. So there's a chart there of HYG. And even though it's been holding on to 77 level, which is a very key level, and you can see sitting right on a 50-day moving average, we really need to see those stay in the game. If they break down under 77, especially under 76.50, which has been the most recent low, it really tells me that there are cracks in the market. Secondly would be the economic modern family, which of course semiconductors is part of, and that's doing well with all the news of Google and Apple and NVIDIA event that's happening today. But the XRT retail sector, the transportation sector, and the grandpa, which is the Russell 2000, are red in a day with a lot of green, another potential sign of cracks. And then the other thing to be watching for is in the consensus of, okay, rates higher for longer, market still doesn't care, thinks everything is fine, we're going to continue to see growth, is the presupposition, if you will, that inflation is not going to get much stickier. So this is why I'm showing you now 2 different instruments. One would be the gold miners. And the reason why that's so important is because historically the miners will lead the gold, but we haven't seen that in this particular year. We've seen gold over 2,100 and it's settling around 2,140 to 2,170. We've seen silver get back over $25. We've seen cocoa, obviously, on new all-time highs. And even though GDX, the gold miners, have rallied and are above the 200-day moving average, if you look at the chart, there's a horizontal green line above that. And that is the January 6-month calendar range high. That's an extremely important indicator because it sets the tone for 6 months, sometimes for a whole year. Many of the instruments that you have been watching, even most of the indices and certainly a lot of the chip stocks have been long above that 6-month calendar range high. And here is the miner struggling to get them. So I think that the best gauge for inflation right now, besides what I'm going to show you in a moment with sugar, is these miners. If the miners can take that level out, which is about another $1.50 from where it's currently trading, around 31.25, then that tells you that the miners are picking up, which is the supply side, which of course would goose up not only gold, but also silver. We're already seeing it in copper and aluminum and some of the other metals. And that would tell me that regardless of a dollar that's been stagnant and yields that have been, that we actually are starting to see commodities separate from that and go into a second wave of inflation. The other chart, of course, would be the sugar chart. And even though we've seen cocoa at record highs, sugar is sitting there at around 22 cents a pound. Let's not forget it was at 5 cents in 2020, so it's still much more expensive. But it's not high enough to create any kind of panic. And sugar is a great barometer because it's in all foods. If it gets up above these current levels that you're seeing on the chart, and say gets up through 23 cents a pound, along with everything else, then I would say that we might see a more aggressive Fed. So basically, to sum up, here's what you have to watch for going into the Fed meeting. In terms of what they're probably going to say, it's going to be what we've heard all along, which is we're going to keep rates where they are. We're, of course, keeping our eyes on the inflation numbers, and also we're keeping our eyes on the job market. Number 2, We're seeing the yields on the 10-year go up, and also the 30-year bonds also have had a spike in the yields, which means the inversion is not necessarily a factor, but it could wind up being the crack in the market. We're seeing the economic modern family in terms of the inside sectors, not necessarily having the same level of FOMO, which could be a warning, but yet tech continues to be strong. So if we can get through these next few days and everything sort of stays status quo, then most likely, unless the Fed does something crazy, we may see the other instruments, particularly the modern family, participate. And if not, then I would start to get very cautious, but nonetheless continue to keep my eye on those commodities, because they would be the key to whether or not inflation is going to continue. Okay, that's it for now. Thanks so much for watching.